My name is Farhan. Today you'll solve question 6 from 2014 past exam. This question requires you to understand the closing of the revenue and expense accounts and look into the three sentences we're given for additional information to prepare the capital account in preparation for the next reporting period. At the end of the question, we're also going to discuss the differences between general ledger and subsidiary ledger. With that being said, let's get started. The following is an extract of the General Journal for Rustic Timber on 30 June 2014. The business prepares reports on a monthly basis. So we're given the General Journal, and you can see we're given the closing entries at 30 June for the revenue account. So we are closing all revenue or income accounts to begin with. So we are closing the sales, which is the only revenue account, against the profit and loss summary. And then we are also closing all the expense accounts, which is to close all the expenses, as you can see given here, against the profit and loss summary, which you can see is debited with the total of all expenses. So the first question is, how can we find the net profit for the business by using the closing of the revenue and the closing of the expense accounts? All right. So first of all, we are closing all revenue and expense accounts based on the accrual accounting assumption, which states that profit is calculated by subtracting the expenses incurred or consumed from the revenues that we have earned for the period. And the reason we close revenue and expense accounts is so that we can start with a zero balance in the next reporting period. Okay? So the business prepares reports on a monthly basis, which simply means we want to find the profit every single month. And every single month we want to calculate the profit. We will be closing the revenue and expense accounts and start the next period with zero balances, because these are also temporary accounts based on the accrual basis of accounting. So how do we find the net profit? It's very simple. You just subtract the difference between the sales and all expenses. Okay. So I can see that the sales are 76,000 in total, which is obviously lower than the total of expenses of 78,300. So let's just say we have a loss. So the reason we have a loss is because the sales are 76,000, which are lower than the total of expenses of $78,300. And what's the amount for the loss? It's $2,300. Okay. All right. So when we close the revenue and expense accounts at the end of the reporting period, where does this net figure go to? So if you're making a profit, it should increase the capital balance, because this profit is available for reinvestment next year. And if you're making a loss, this should decrease this capital balance, or owner's equity, because now you're left with less for reinvestment in the next reporting period. Okay, so the additional information says that the opening capital balance on 1 June 2014 was $51,200. And at 30 June 2014, it was $50,350. So we are given the opening balance at 1 June and the closing balance at 30 June. So let's look into the capital account, which we have already prepared. Now, capital by default is always credited. This means that the opening balance of the capital account is always on the credit side of the ledger account, and the closing balance is always on the debit side. This also means that when capital goes up, we credit them. And when capital goes down, we debit them. Okay? So you can see the opening balance on the credit side, 1st of June, 51,200, and the closing balance on the debit side, 30 June, of 50,350. Now, on the debit side, you can also see that I have included the loss of $2,300, and I've written profit and loss summary as the cross-reference, which is the correct way to do so, because this loss of $2,300 comes from the closing of the revenue and expense accounts, which are directly relevant to the profit and loss summary, and you therefore should write profit and loss summary here. Now, the fact that we have a loss of $2,300 reduces the owner's equity, And when capital goes down, we debit them. And that is the reason behind why this is on the debit side. Okay. Now, during the year, based on the additional information, we know that the second sentence says the owner contributed $1,250 cash and a computer valued at $1,000 in 30 June 2014. So this is referring to additional capital contribution. So capital is going up, and if capital goes up, we have to credit them. So we got cash of $1,250 that we injected into the business, and then we also contributed a vehicle that's worth $1,000. And this too refers to additional capital contributions, which is increasing the balance of the capital account and is therefore included on the credit side separately as computer and cash 1,000 and 1,250 respectively. Now, the third additional information says the owner took cash drawings during the month, and they didn't really mention how much it is, which is what we have to calculate ourselves. All right. So the reason drawings is on the debit side of the capital account is because drawings also reflects a reduction in owner's equity, which also means less reinvestment available for the next reporting period. Okay, so how do we find this amount for drawings of 800? So let's assume we do not have this amount to begin with. So how do we balance the capital account? We take a glance and we know which is the heaviest side. So the heaviest side is the credit side, assuming that we do not have the drawings figure, which is what we are calculating as the missing figure. So we find the total of everything on the credit side, which is 53,450, which must be the total of everything on the debit side to ensure that the fundamental rules of accounting apply. And once you subtract the loss of 2,300 and the closing balance of 50,350, you're left with $800 as the missing figure or the deficit on the debit side to ensure that both sides match. And that is what we refer to as the cash drawings. And the reason this is also on the debit side is because this reflects a reduction in owner's equity. Make sure to transfer the closing balance into the opening balance in the next reporting period, 1st of July 2014, and that's 50,350, because you will lose marks if you do not include this. All right. Okay, so what about the general ledger and the subsidiary ledger? Now, the general ledger contains accounts for all assets, all equity, all liabilities, all expenses, and all income. What about the subsidiary ledger? Now, the subsidiary ledger, you can understand this by referring to an example that I'll show you. So let me draw an example. So let's say that within the general ledger, we have the asset account for accounts receivable. Okay, so this is the first example I'm going to use. Now, accounts receivable refer to the credit customers of the business. In the general ledger, we show the summary of all transactions that we have conducted with all the credit customers of the business. All right, so this is a summary of all transactions conducted with all the credit customers of the business. So the accounts receivable or the sales ledger control account, which are the same thing. So since this is a summary of all the transactions conducted, we have the total of credit sales, we have the total of discount expense or discounts that we have given as a business to our credit customers for prompt payment, and the cash that we have collected from our credit customers during the month or during a reporting period. So the general ledger, as we mentioned, contains the summary of all transactions, but this is reflected in the subsidiary ledger as a detailed and individual customer accounts. Let's say the only 3 credit customers of the business are customer A, customer B, and customer C. So in the subsidiary ledger, we are going to have accounts for each of these customers where we are going to be where we show all the individual transactions that we have done with each of these credit customers. All right, so I believe you got the idea. So subsidiary ledger is a more detailed record of individual customers that are involved. Let's look into a second example. For example, let's say accounts payable. So in the general ledger, we record the summary of all transactions that we have conducted with all the credit suppliers of the business, because accounts payable refers to the credit suppliers. But if we were to look into the subsidiary ledger for this, we would have separate accounts for supplier A, separate accounts for supplier B and supplier C, right? And each of these accounts will show the transactions that we have conducted with each of these suppliers separately. Okay? So that's all in terms of the difference, which you can understand, and that should be good enough for you. That's all for today's lesson. I'll see you in the next video.